Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to take a look at history and kind of how these markets moved in history, the last two bull markets in commodities. There's a question here, it's on Twitter. I'm going to answer it, at least to the best of my knowledge. And again, guys, I'm just taking information and trying to overlay it with stuff that's happened in the past. It's not like I'm making predictions. I'm not trying to predict the future necessarily. What I'm trying to do is position in high probability bets where the favors are in my camp. It's all about statistical probabilities, not necessarily making predictions. But it's also worth knowing what history has done before when looking at different herd mentality, like how did this thing play out last time or the one before? What I'm going to do is I'm going to look at the last one, the last bull market in the mid 2000s, use that one for a go-to kind of, test bed, so to speak. And it also happened in the 1970s, which we'll also look at for some of the data, not all the data, but some of it. So let's get into the question here real quick. The question is, let me zoom in so you guys can see it too. So as you mentioned during your conversation about the investment strategies a day ago, that at the next rally, the S&P 500 and the precious metal sector will move together and will decouple because of the monetary issue. That is your forecast. Well, that's what happened in the past. It's not what I'm forecasting necessarily. What I'm saying is that's kind of what I think may happen based off of history. I don't really try to make too many forecasts. I'm not trying to make predictions. Like I think oil is going to go higher, and there's a bunch of different numbers that you can put on it, depending on what you want to do. If you want to use ratios, the number is going to be very high. If you're going to use other means, like I don't know, some people like using affordability and stuff like that, it may not get as high, but it's tough to say. Number two is what kind of yield bond and M2 supply curve are we going to see if that happens? I mean, a kind of warning sign about this issue, is it enough if the PM sector is going to outperform, break the ratio trend line, maybe retest? If that's going to happen, why do you think that the main market are not going to influence this subgroup? So I'm going to answer some of this stuff. I don't know if I'm going to answer all those questions, but let's get in here. And I'm going to tell you some information, some data that I'm just noticing as we go along. In the 1970s, 1968, 68 is basically this portion here. We did some money printing. You can see the M2 money supply going up. In about 1980, that's kind of like the peak for a lot of stuff. But that was what the M2 money supply looked like during that time frame. It was a pretty steady uptrend. In the year 2000, 99, so 99 to 2008, there's another steady uptrend line there. And this one, I would say the bottom was in 2020, and we had a massive move higher. But one thing I do notice in this M2 money stock is recently we have a downtrend in the money stock here. Look at this. This is a peak here. I don't know why it's not allowing me to do that this way. There's a peak there at 21.746 trillion, and it's actually falling down to 21.5 trillion. So we've seen a 0.2 trillion decline in M2 money stock. And usually in the M2 money stock, when you see a decline, that's going to be deflationary. We saw back in 2009 when we had all of those bad loans in the system. So if I were to go back here and kind of zoom in here, so we had the crash in 08, and really the money stock didn't fall. We just kind of paused a little bit from 8.3 trillion all the way to 8.5 trillion, kind of sideways here in 2009. Not really a decline in the money stock. We had a decline in 03 from 6.118 down to 6.082. There's not many declines in the money stock over periods of time. But this one seems to be a little bit more pronounced than the rest. And should we be worried about it? I'm not too sure yet. And I'll show you some other information on why it may or may not matter. I mean, we're gonna look at some other data, but this is something that I notice, and it's been like this since March of 2022. And this here could be a leading indicator, could be, of a slowdown. Now, another thing you want to look at is the money velocity. The money velocity, M2V, is what they've got here. This is the equation for that is your total number of transactions times the price level divided by how much money's in the system. And what's crazy is the velocity of money, and I know the most recent data is July of 2022, is actually spiking higher. And I'm not exactly sure, because I mean, some of this stuff is kind of highly manipulated. The price of all this stuff, I think they use the consumer price index, and they've been manipulating that lower, so you'd see this go down. It also means that M2 money stock is probably going into financial assets, where the velocity of money would be very low. It's not hitting the transactions and the average price. But now it is. Now it is. It's going up. So is that offsetting the decline in the M2 money, money stock? I think it is. Yeah. I think the velocity is making up for it. Now, they obviously don't want to have M2 money supply go up at the same time that velocity goes up, because then you're going to have like massive inflation. That means that you have more money in the system and it's traveling faster in the system. I'm still kind of confused on how they calculate this exactly. I don't think it's a very exact measurement, so I don't know how accurate it is. If you look at the equation, it's the price level, which is the consumer price index, times the number of transactions. So it's an average price level times the number of transactions. And I don't know how that would accurately predict anything, because I would imagine that the CPI is highly doctored up massively, and your average price level is far lower than what it would normally be, say, back in this general area back here. If we were to take a real inflation rate, I don't think this would go down as much. I don't think it would be skewed the way that this looks like. So when we talk about it like in engineering, if you've got bad data, I mean, you basically don't want to do any any analyzing on that data. You have to get good data first, and then you can analyze it to the yin yang. But here, I don't know if this is apples to apples comparisons. Back here, this is different data than over here. So how do you know that the velocity is any different than the velocity over here? We don't. That's where it gets a little bit weird, because they play with the CPI numbers. Plus, the average number, the number of transactions, I would think that the size of the transactions would also matter. And how do you get an average? You take an average number of the size of the transaction, which is highly doctored and manipulated, and multiply it by the number of transactions. Of course, it's going to have a massive impact on this calculation, especially if you usher that back in the 90s. And that's when this thing rolled over. I think they did it in 96, where they could basically doctor the numbers, and it's been heading lower. So one way that I think you can kind of see the money velocity is it would be your M2 money supply divided by your GDP. Actually, I think I have that over here. So if you look at your M2 money supply divided by your GDP, this would be another way to basically see a different picture here. So remember that the money velocity, maybe we can throw that on here. Let me put on money velocity. And I have not done this yet. This is my first time doing it. So, and this is probably just going to be an inverse relationship to M2 divided by GDP. because your GDP, your gross domestic product, is the number of all. It's basically the summation of all transactions and money in a system. So if I were to take this and invert it, and again, guys, I have not played with these before. I am willing to bet that if you invert this, and let me see if I can invert it, because I'm not. Settings, inputs. Not sure how to invert this here. All right, guys. So what I did is I figured out how to do this, and what I did is I took the I took the GDP and divided by the M2 money supply, and that's what they used, I think, to find out what the money velocity is. It's your GDP, gross domestic product, divided by your M2SL. And that is showing me exactly what we get here, is money velocity, M2. So if I take money velocity out, that's what that is. I'm just going to click on this. So this is the inverted, this is just M2 divided by GDP. If your M2 money supply is growing faster than your gross domestic product, what you get is an inflationary kind of move. They changed the way that they measured this in 1996, from what I can remember, with hedonic adjustments and all these other things. So I do think that this is a doctored up. I think there's a lot of, we'll call it, underreporting of inflation. And this is basically taking the inflation out of it and just looking at it. And you can see that we have lost a lot of productivity. We've been creating money at a faster pace than our gross domestic product. That's why it's gone up like this. Obviously, we can see that it's declined here. If you divide this out, your GDP divided by M2SL, this is the money velocity inverted. This graph is the money velocity inverted. So when we look at this, money velocity matters, because really what inflation is more or less the balance between how much money is in the system and what your GDP is, the amount of goods and services. And this here is basically saying that we've got a bunch of money in the system in relationship to GDP. And how this money floats around in the system, like where it decides to park itself, can be seen in the consumer price index. So if it parks in financial assets, it's basically hidden in the system. It doesn't show up in the consumer price index. But if this money gets out in the hands of people and it tries to go after real things in the world, whether it's financially driven or driven by stimulus checks that were handed out to people, it doesn't really matter. It's going to be seen then. And if that money tries to go after real things in the world, the money then gets counted in the consumer price index if it tries to go after oil, copper, or any of these other real things. If it hides out in financial assets, that's great. You get a gigantic financial bubble, which we have. But it's not seen in the consumer price index. It doesn't impact the bond market, really, because you're not going to get that huge inflationary push. Now, with the large increase here of money injected into the system, we're seeing it in the consumer price index, which then has problems in the system. So when we look at this, and there's a couple of things I wanted to touch on. The Standard and Poor, S&P 500. If we take a big picture view and I hit logarithmic here, we can see these periods of stagnation where the stock market goes sideways. And I made a statement where I said that the stock market and the precious metals market could go up at the same time. And that's where I'm going to show you what I think here. So first, I want to describe these sideways motions. This one here was a commodity boom, but it was also a period, a lull, so to speak, where we kind of consolidated in the market for a while. but there was commodity bull market. And you can also see, let me pull this here real quick. We can see that this also had a three-wave pullback here, or consolidation zone. So each one of these has a three-wave consolidation. So it's wave 1, wave 2, and then wave 3 looks like that, and it usually breaks out. Each one of these has this three-wave pattern, and hopefully you guys can see all this. 1 wave, 2 wave, 3 wave, and then the break. 1 wave, 2 wave, 3 wave, and this one didn't go all the way back down, but it broke. That is what I normally see in these consolidation periods. If I were to pull up a commodity chart, it has this three-wave pullback. Now, when you look at this, I think what's coming, and I drew it in here. What I did is I took the start of this wave and copied this entire wave and put it up here, which is saying that we could see something similar to this. I'm not saying that it's going to be exact. So I copied the last bull market and the consolidation period from the breakout retest here to the top here. And then I overlaid it, shrunk it up so this matches that. And you can see that the match is pretty good. And then I think this is going to be something on the lines of this that could happen, where we consolidate in a three-wave pattern. What I said is there's the potential here where we go up multiple times together. So what I'm going to do is I'm going to add gold in here. Gold, actually, let me take that one out. 1 second, guys. Back it out. I'm going to put it on a new pane here. So 1 second. So if I put it on a new pane, what we're going to do is we're going to see how this thing overlays. So I'm going to put a vertical line. And at the bottom of the vertical line, that's where that bottom is. And I'm going to copy it, and I'm going to put where the top is there. And what you see, and the claim that I made, I'm going to do this again. 1 second here, guys. I'm going to put another one here. I'm going to put another one kind of at the top here. There's the top there. So this one's a hair different. But what we could potentially see is we come on down, and then gold starts to kind of front run this. And this will tell us kind of where we are in the cycle as well. Again, guys, you know, I look at this stuff. I've kind of looked at the history. I've looked at the charting and stuff like that, and I'm kind of just doing overlays here. It may not match, but it's probably going to rhyme what I'm saying. And if we get a three-wave consolidation like we have in all these other consolidations, and we get a three-wave consolidation or a three-hump consolidation, whatever you want to call it, we saw that in commodities as well. I see it all over the place. This isn't just here. So it's not contained to here. But what I saw last bull market is in 2002 to 2007, we had a large move higher along with a large move higher in gold. And I said my last one that they could potentially go up together, just like this in history. It also in wave 2, we didn't really see a big move in gold at all during wave 1 in the 1970s. Let's kind of just dive in here real quick. There was a move, but it wasn't massive. This was a much larger move on the second wave here with stocks going higher. Now, keep in mind, this kind of crashed down in the beginning, very similar to what we're doing today. Think of another a monetary loosening, and on top of it, more money coming into the system. Interest rates coming back, but there are some differences here. This is in the 1960s, 70s. There are some differences here. This one was a blowout type crash here in the housing market. We overproduced, and the demographic pulled back during that time frame. That also had an impact on gold a little bit. And then we went into another one where the housing market went up again during this time frame here. all the way up to this point here. And there's when gold peaked. Same rough general time frame. So there's times where we see gold and we see the markets go up at the same time. And I think the first portion, it's less so correlated, more so correlated with the second and third humps. We haven't done, if we look at the first hump, we don't have a correlation here with gold. We have the second hump, and there's that correlation here where it went up, and then the third hump also went up on the reflation trade. Then it broke apart as stocks broke out and ran. And I think that's what's going to happen is we've got these humps here where the first hump, as we tighten into all this, they did a stimulus in the beginning. That's when gold ran, and then it tightened way up. And this is where it's going to bottom at some point. I don't know exactly where. Could we have a little bit more sideways motion out of the S&P and a little bit further downward move? I think so, if it were to repeat like it did in the 2000s. And then I think gold's going to take off. We're seeing the downtrend line break. We're seeing the move higher. We're seeing a lot more buying pressure than selling pressure. So I think everything's aligned for that to happen. And we saw that in history before as well, back in the 1970s and back in the 2000s. So I think we're getting close to a move, and I think we're getting close to a bottom at some point. And this is just a sheer approximation. This isn't perfect, guys. But it gives you an idea. And it also gives us an idea if history were to repeat like all these three commodity bull markets before it, that we would have a 3-wave cycle. I don't know why we wouldn't. It seems pretty ingrained into this cycle here. So, and I don't know how big this is going to be, and I don't know if the line's going to be down here or if it's going to be right where it's at. It's hard to say. I mean, I don't know that. I'm just showing you guys kind of historically what has happened in the past. And I'm not making forecasts. I'm just saying this is what history has done, and this is kind of what my expectations for this to repeat. Now, I also think that the market conditions of these timeframes could be a little bit different. Why do I say that? Well, I mean, in these three areas, we had massive amounts of commodities on this planet. Very high grade with a bunch of energy all around us. In the 1970s, this bull market in commodities, and obviously it was not a bull market in the S&P 500, this sideways motion, that was a large, that was a period where we had a demographic inflation come through and an energy crisis at the same time. I don't think the 2000s was really an energy crisis. Our inventories were going up during that time frame. So I think the inflationary pressures during this time frame were not nearly the same as the 1970s. And I think the 1970s, with the United States energy crisis, and the move in gold that happened, I think that's going to mirror what's coming up in this time frame, because I think we have an energy crisis on a global scale, and I think we have a lot of money in the system, and a lot of the credit cycle, I think, is more intense. So I think the problems are bigger on this side over here on every front that you can think of. So I think that the credit cycle ending, the obligations, the Medicare, the Medicaid, the pensions, and all these other things, I think there's a lot more inflation being driven naturally by the demographic that drove the inflation in the 1970s. The demographic in the 1970s, the baby boomers, drove it from buying homes in the system. They were buying homes. The money velocity kicked up or stayed elevated with an increasing M2 money supply. So this is where the inflation came from. Now that demographic is also coming into, this is a double whammy, is coming into retirement age. And we've got all these obligations in the system. And now they're going to be drawing on those obligations. which is going to be inflationary because they don't have the money to pay these people out. So they're just going to create it from nothing. So those obligations are here. And we've got the millennials, which is the kids of those baby boomers coming into home buying years, which is inflationary on that aspect. So we've got a credit cycle that's kind of ending. We've got all these obligations where they have to print money to give for pensions and whatever else there is, Medicare, Medicaid, all this stuff. Then we've got the pressures from the millennials coming into home buying years. So it's a stacked up inflationary mix. And with the energy crisis, basically stating that you don't have your GDP that can grow, because GDP is more or less a derivative of energy. All goods and services are derivatives for the most part of energy. So we've got this energy crisis stacked on these demographic, which is coming into retirement, which is coming into home buying years, which could be very inflationary. And then we've got a credit cycle put on top of it, high interest rates because of the market conditions that are there, and an energy crisis. This could be massive for energy, the price and cost of energy, and for precious metals. So I think if this plays out the same way as it has in the past, that we could see the S&P 500 and gold go up at the same time. We could have a potential crash at some point when we lose the housing market with too much inventory. I don't know if we can go into that right now. I don't know if we have the inventory. All of these previous crashes, every single one, had inventory levels over 12. So, and again, I don't have the answer here. I'm just stating the facts that this crash had inventory over 10 or 12 months. The crash back here had inventory over 10 or 11, 10, 12 months, somewhere in that time frame. We overbuilt in housing starts. We overbuilt in housing starts. We overbuilt in the mid 1920s and had this crash from the housing market. The housing market's what's driving all this, in my opinion. We had the crash in the 1920s and in late 1920s, which then screwed up the entire banking system. And then we had the three, 1, 2, 3 consolidation hump. Same thing here, just later. And then we had one in 2008-9, which started in 06-07 with the bad loans. Same with the 1920s was bad loans. This was the demographic running out in the 1970s. And now we don't have that pressure over here because we don't have all the homes in the system. We didn't overbuild. It hasn't been overbuilt yet. So I still think that that's yet to come. And the charts tell us that if you look at the XHB, your home builders index, is showing us that we've had a consolidation period. And this usually comes right before the move, this I call it this little hook thing. And then we broke out, we're doing a retest, and we're going to take off into a bull market that's probably going to last, 10 years from the breakout. So 2030 or something, which aligns with our SPX chart. So if we go back and we look to see where this thing ends, that's at 2030. It all aligns when I hook all these together, and it all lines up. Now, is it me making predictions? No, it just, I don't know, turns out that way. And that's what almost all of the charts are kind of suggesting. So that's what my thoughts are around all of these different areas, guys. That's what I'm seeing. Am I right? Put it in the comment section what you think. Am I right or am I wrong? I don't know. I'm just taking data from some of these charts, overlaying it, and just trying to say, hey, look, this is a potential case that you could make looking at history. So could gold and the S&P 500 go up at the same time? Yeah, gold could also go up in the beginning stages when the S&P is still falling. Could we still fall in the S&P for a little bit? For sure we could. For sure we could. If it's like any other historical patterns. If I were to throw, here, I'll throw the 1970s on here, guys. Let's do the 1970s for the heck of it and see how this overlays. based off that. So I'm going to grab this from the 1950s all the way till the breakout. I'm going to grab this and put it up over here. And what you're probably going to see is a very similar trait when I put this back up. So we come over here and there's your trait there. It's a little bit different, but it matches the size of the move. It's a little bit more, I would say it's stretched out a little bit more, but it's somewhere in this vicinity there. And you can see the way that this thing moved is very similar. You got the 3 humps and then the break. I mean, this is it is very similar to both of these charts. They're a little bit scrunched up or a little bit drawn apart, but all very similar. And I think what's going to happen is I'm going to grab one of these just to show you guys. So what I'm going to do is I'm going to grab, I'm going to take it a little bit different. I'm going to grab the top here, the top there, and the breakout, just for the heck of it, and we'll see what happens. I'm not stating that this should happen. I'm going to go back to the CRB index here. So we're going to go to the CRB index, which also has our 3 humps, hump 1, hump 2, hump 3. I'm going to take this guy, I'm going to take it and throw him. This thing's way up there. Let me shrink it down a little bit too. Let's see what this kind of looks like at this time. So there's our humps, and this is not going to match perfectly, but we'll just see where this thing could potentially go as I shrink this and stretch it out. Let's go to logarithmic, auto, and so I'm gonna just drop this thing down and see. So if we were to match this and it were to come down, that's kind of what it looks like from this perspective. And if I were to just to try to align this here, that is what it looks like. You get this move up, and this is kind of what I think is going to happen. Something similar to this, where we come all the way up to like 600 and something, which means we go over double to the upside here. And it may not. We may be even bigger than that. If you were to look, what could happen, or one thing that could happen, is it looks something like, like that, where we get out to about 2030. This is one big leg higher here, and then you get a third leg and then a fifth leg. The fifth leg's here, the third leg's this guy, and then this is the first leg. That's probably what it will look like, in my opinion, playing with chart overlays. Am I going to be right? I don't know. But this would indicate that we do a 10x in commodities in relationship to where we are today. I don't know if that's going to be the case, but I think it's a possibility. And that's taking the movement in the S&P 500 and overlaying it on our commodity index. So, but that's what I've got for today, guys. I'll end it there. A lot of stuff going on. And let me know what you guys think. Put it in the comment section. I'm just playing with numbers here. This isn't forecasts or projections. I'm just saying, this is what we could see based off history. All right, guys. If you guys like this type of analysis, I do a lot of this analysis also on the website, thefinding-value.com. Become a platinum member. Join me for this next commodity bull market. And I've got a lot of really good plays. I do a lot of charting. We can look at all this stuff together during the platinum and question and answer sessions. I've got one coming up Sunday at 5 p.m. Love to see you there. And we can look at some of this stuff. You can ask specific questions on companies. I do a lot of fractal analysis, looking at the size of the patterns, figuring out, what could the potential be. It doesn't mean I do that on everything, but I do it on a lot of things. There's also Fibonacci retracements, Fibonacci projections that you can do that also match basically the fractals. It's all the same. It's all based off of fractals. Fractals are repeating patterns that happen over time on different time frames, and the size of those patterns is the genetics, is the DNA of the stock. Larger fractals, more volatility, bigger moves, if that's what you want. But that's what I've got, guys. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And we'll catch you guys next time. This is Finding Value.